When I first started trading, my charts were, well, they were a complete mess. It looked like a kindergarten art project. I had so many colorful lines and indicators on there, I could barely even see the price. I was just hoping one of them would finally give me the magic signal. It was just overwhelming. And then I had this moment of clarity. What if the secret wasn't adding more stuff, but focusing on way less? So I stripped everything away, and I built a simple, clean strategy around just 3 core tools. And that's what I want to share with you today.
Man, this quote just hits the nail on the head, doesn't it? We've all been there. That endless search for the holy grail. That one indicator that's going to be right 100% of the time. It's this universal hunt for certainty in a world that's all about probability. But let's be real, that perfect indicator, it just doesn't exist. And this whole hunt, it leads to this love-hate relationship with your charts. You know how it goes. You find a new tool, you get all excited, you slap it on your screen, and for a minute, you feel like you finally cracked the code. But then, it gives you a few bad signals, and that old frustration just comes creeping right back in. It's an exhausting cycle, and honestly, it just distracts you from what really matters, which is learning to read the price itself.
So yeah, I decided to break that cycle for good. I wiped my charts completely clean, and I asked myself 3 simple questions. Before I even think about a trade, what do I absolutely need to know? 1, what's the trend? 2, how strong is it? And 3, who's actually driving this move? And that line of thinking led me straight to my 3 essential tools.
And really, it is this simple. First up, moving averages. They just give me a clean, visual read on the overall trend. Next, the Relative Strength Index, the RSI. That's basically my momentum gauge. And finally, volume. Volume tells me how many people are showing up to the party, how much conviction is behind a price move. That's the whole toolkit. These 3 things are the entire foundation of how I look at the market.
All right, let's break down the first one. The most important question you have to answer is, what is the trend? You got to know which way the river is flowing. And for me, the absolute simplest way to see that is with a moving average. It's my compass. Just take a look at this chart. Without that blue line, the moving average, the price looks kind of choppy and random, right? But the moving average just slices right through all that noise. It gives me this nice smoothed out line that tells me the general direction at a glance. If the price is staying above it, hey, we're in an uptrend. If it's below it, we're in a downtrend. It's the first filter I use for any trade idea. Simple as that. Now, there's a really crucial word on this slide. Lagging. You have to get this. A moving average does not predict the future. It's not a crystal ball. It confirms what's happening now by showing you an average of what's already happened. Its job is to keep me on the right side of the market, to help me trade with the established trend until it's obvious that trend is changing.
Okay, so once I know the trend, my next question is, all right, how much gas is in the tank? Is this trend actually accelerating, or is it kind of running on fumes and about to stall out? For that, I turn to tool number 2, the RSI.
I absolutely love this metaphor of a speedometer because that's exactly what it feels like. The RSI, that line at the bottom of the chart, it tells me how fast and how strong the price is moving. If the RSI is climbing, momentum is building. If it starts to flatten out or drop, things are slowing down. It's kind of like my early warning system that a trend might be getting a little tired, even if the price is still creeping up. Now, the classic way to read the RSI is with 2 key levels, 70 and 30. When that line pops up above 70, we call that overbought. It's a sign that the buying might be getting a little too crazy and a pullback could be coming. And when it drops below 30, that's oversold. It suggests the selling is getting overdone and we might be due for a bounce. I use these levels to help me time my entries when the price pulls back within a trend. So, I've got my trend direction and I've got my momentum reading, but there's one last critical piece of the puzzle. I need to know if the big players, the smart money, are actually behind this move, and that's where my final tool, volume, comes into play. The simplest way to think about it is this: volume equals conviction. It's the size of the crowd behind a move. I mean, think about it. A price breakout on really low volume, that's like throwing a party and nobody shows up. It's not very convincing. But a breakout on a huge spike in volume, okay, now that tells me that big players are committing serious capital. There's real belief behind that move, and that gives it credibility. Okay, now here is where it all comes together. The individual tools, they're useful for sure, but they aren't the strategy itself. The real magic, my secret weapon, if you want to call it that, happens when all these different signals line up in the exact same spot on the chart. This is the power of confluence. So what is confluence? Well, it's just the idea that when you have several different independent reasons to take a trade, and they all point to the exact same price area, the probability of that trade working out goes way, way up. It's like getting a second and a third and a fourth opinion, and they all agree. That's the setup I patiently wait for.
So what am I actually looking for? Well, I'm scanning my charts for a zone where a bunch of these things overlap. Maybe there's a major support level from last week that lines up perfectly with a rising trend line. And right at that exact same spot, the price comes down and touches my moving average. And at the same moment, the RSI dips into oversold territory. When I see all that happen at once, my ears perk up. That's what a high probability zone looks like to me.
All right, so how do I take this idea and turn it into something I can actually repeat day in and day out? I follow a very strict 5-step checklist for every single trade. It's disciplined, it's systematic, and it's what keeps me from making dumb emotional mistakes. Let's walk through it. Okay, here we go. Step 1, I use my moving average to make sure I'm only looking to trade with the main trend. Step 2, I hunt for that key confluence zone, that spot where multiple factors are lining up. Step 3. As the price pulls back into my zone, I'm watching my RSI speedometer. In an uptrend, is it getting oversold? Perfect. Step 4. As the price starts to turn around, I need to see that spike in volume. That tells me the buyers are stepping in with real force. And finally, step 5. The trigger. I wait for a specific price action signal. Usually for me, that's a candlestick pattern, like a bullish pin bar. That's that little wick that shows sellers tried to push it down, but boop, buyers pushed it right back up. It's a visual sign of a power shift. And I mean it, I absolutely do not enter a trade until all 5 of those boxes are checked.
And that right there, that is a huge mindset shift. My goal isn't to be trading all day long. My goal is to sit and wait patiently, like a sniper, for those A-plus setups where all the stars align perfectly. Trading isn't really about action. It's about having the discipline to wait for the right moment.
Because look, having a great strategy is only half the battle. Real mastery comes from internalizing the principles behind the strategy, things like discipline, patience, and maybe most important of all, risk management.
This might just be the most important slide in this entire explainer. Let me be perfectly clear. No strategy, I don't care how good it is, can give you certainty in the markets. It's a game of probabilities, full stop. This confluence strategy is designed to stack the odds in my favor, but losses are still going to happen. They're just a part of the business. The goal is to make sure your winners are bigger than your losers over the long haul, not to try and win every single time. And that's exactly why risk management is not negotiable. It's everything. For every single trade I take, I have a predefined stop loss set just on the other side of my confluence zone. I always risk the same small percentage of my account on every trade. That way, no single loss can ever be a catastrophe. This is what keeps you in the game long enough to actually see your edge play out.
So I'll just leave you with this question to chew on. In trading and in life, we're so often told to look for more complexity, to add more tools, more variables, more confirmations. But what if the real path to clarity and consistency is actually the exact opposite? What if it's all about subtraction, about intense focus, and about truly mastering a few simple concepts that actually matter?